This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Page 52. Well, you can see it's headed up inflation. I'm about to explain, obviously, but something that is unlikely to be relevant for the numbers. It just could, but it's very unlikely. It just could be relevant, though, for a bit of a written part. Okay? So it's very small, but look straight at the example. Ignore that formula and everything. It's a very short one, but just to try and explain one point, just to be safe. A new machine will cost 120,000, is expected to last 3 years with no scrap value. It's expected that production will be 10,000 units a year. The selling price is 20, the production costs are 14. They're both quoted in current prices, and there's inflation. Inflation is 5% a year. The cost of capital, 15%. All right? Yes. So again, a very short one. I don't want to waste time. But I'll say later, this could have been sort of 15 years instead of 3 years. It would obviously make it a lot longer. All right? Well, how did we deal with it yesterday? It's a 3-year project, so we set up our years. The operating flows. Well, we're going to sell 10,000 units a year. First of all, the revenue. It's $20 a unit, so what does that come to? I work in thousands. So $20 a unit, 10,000 times 20. It would be 200,000? Yep. Hello. But I did stress yesterday, I think it was yesterday, that check carefully. He could either tell you it's 20 in the first year and then it inflates. If it was 20 in the first year, the cash flow at time 1 would be 200. Or, as here, it says it's at current prices. Automatically, if you ever see the word current prices, it means that if the first flow is in 1 year's time, there will be 1 year's inflation. You remember? So no problem. There's inflation, it's at current prices, there's inflation at 5%. And so the cash flow at time 1, check me. I'll say I'll work in thousands. 200 times 1.05. Is it 210? Come on, help me, you are all with me? And of course from then on, whether it's 3 years or 20 years, you would just inflate at 1.05, multiply by 1.05 a year, which gives me, I'm doing to the nearest thousand, so it doesn't matter which way you go, but 221 at time 2. I kept it in my calculator, I get 232 at time 3. So nothing new, but we are all happy, I hope. And similarly, with all the operating flows, the only other one here is the production cost. Here, $14 a unit. Again, it's at current prices. Again, it's inflating at 5%. And so I don't think I need to show workings. 10,000 at 14, 140, times 1.05. Check me, but I think it's 147 at time 1. And then again, increase by 5% a year. I get 154, 162. But please check me, please. Everybody trusts me. You could all have written down complete rubbish. In the exam, you have to do it by yourself. Oh, that's right. More importantly, you're all clear what I'm doing. And certainly, I'm not stupid. I may look it. But because here they're both inflating at the same rate, I could have just said revenue 20, cost 14. I could have just said it's a net 6 and put 60 a year inflating, yeah? I mean, I prefer not to. I'm always scared in an exam I may have misread. You know, there'd be more words to it. I prefer to keep each one separate. And then if I've misread one, I still get the marks for the other. But that, you know, that's minor. However, that gives us operating flows each year of 210 minus 47, 163, time 2. That's wrong. You've all copied it down and it's wrong. I'm sorry. That's because it's Friday. It's 63 at time 2. 67 at time 3. 70. So no problem, it's only a baby one, I'm taking far too long. There's no tax or anything, I've kept it really simple. And so, they're the operating flows. As far as the capital flows are concerned, we've got the original cost of 120,000. There's no scrap value. And so, there we are. Our cash flows, 120, 63, 67, 70. Discount at the cost of capital, the discount factor at 15%. For 1 year, 0.87, 2 years, 0.756, 3 years, 0.658. And so finally, the present values. I think I'm right. We'll soon find out if I'm wrong and you haven't checked me. But again, you're more importantly, you're all clear what's happening. All right? There's nothing new there at all, clearly. And certainly, whatever's coming, if it's a short project, 4 or 5 years, that's all you'd ever do. That's what he'd expect you to do. Clearly 4 or 5 years takes a minute longer. And like you saw yesterday, clearly I could have had a few other revenues, costs and things, make it a bit messier, yeah. But there we are. And 99 times out of 100 in the exam when there's an inflation, that's all you're doing, okay? However, two things. First of all, you'd agree, had this been 15 years, it wouldn't exactly have been harder, but it would have been obviously taken a lot longer to have 15 columns and everything. Secondly, in this particular situation, there is an alternative way we could have done it. And I'll tell you when to do it in the exam, and I'll say it is very rare. Normally, that's it. I don't want to confuse, all right? But here, surely, everything was inflating at 5%. So every year, I was multiplying by 1.05. You know, year 1, it was times 1.05. Year 2, you'd effectively multiply by 1.05 squared, 1.05 cubed. You agree? And when we discounted, although in the exam you only ever used tables, you saw when I did that brief introduction that the discounting effectively, I don't know if you remember, but you were multiplying by 1 over 1 plus the interest rate. Do you remember? And the exam, I mean, I said at the time, I'm not really bothered there. He'll only ever expect you to use tables. But strictly, the discounting, you're dividing by 1.15 for 1 year. For 2 years, it's 1.15 squared. You agree? And so on. And Dina understood it because she checked the tables. That was no problem. But if you think about it, every year, the operating flows, every year, I'm increasing them by 5% to get present value. Well, having increased them by 5%, we're then dividing, in a sense, reducing, in a sense, by 15%. And so every year, up by 5, down by 15, to get the present value. Well, you can effectively do both steps in one. Instead of going up by 5 and down by 15, we could, I think you probably see what I'm getting at, but I'm about to show you. Instead of up by 5 and down by 15, you could simply do the 2 steps in one. In a sense, it's not going to be quite as I'll show you, but in a sense, if I just put them down by 10, which isn't, it's not going to be precisely that, but going down by 10 would be equivalent to going up by 5 and down by 15. Are you with me? And so there is an alternative, and the alternative, I say again, instead of inflating and then discounting, and it's part B of the question, what we could do is just take the current price flows, take the flows at current prices, you know, if there was no inflation, we already know, you get 20 in, you pay 14 out, you know. We could take the flows at current prices, and as I say, instead of messing around inflating them each year and then discounting them each year, we could simply discount them at what you might call the net effect of up by 5 and down by 15. The net effect we call the effective rate. And that's what we're about to do. What's the equivalent of going up by 5 and down by 15? Well, I'll show you, although there is a little formula. But you see, every year we took the current price flows and you multiplied by 1.05. All right? Squared for 2 years, cubed for 3 years, and so on. To discount, we then multiplied by 1 over 1.15. Squared for 2 years, cubed for 3 years. True? So, what you could have done, you could have gone straight to present value, multiply by 1.05, divide by 1.15. Are you still with me? And if you divide top and bottom by 1.05, 1.05 divided by 1.05 is 1. 1.15 divided by 1.05. Oh, sorry. I get 1.0952. Now, don't worry too much, but because, as I say, there is a little formula instead of having to think about that in the middle of an exam. But all I did there, I'm saying to go from the current price flow to the present value. Every year you multiply by that to inflate, you're dividing by that to discount. And as I say, all I've done is said, well, if you divide top and bottom by 1.05, again, I don't know if anybody's checked me, but I get 1.0952. All right? Well, think about it. If I were just to multiply by 1 over 1.09, is that not the same as discounting it at 9.52%? And what we could do, again, instead of what we did there, inflate then discount, we could simply discount the current price flows at 9.52%. And you'd get, I'll show you in a minute, but you'd get exactly the same answer. It would be slightly quicker. Now, I've told you, I've already said, the chances of numbers on this are actually very tiny indeed. But I did tell you the other day, if ever for any reason you end up with a strange discount rate, he'll never expect you to discount at something like 9.52 because it isn't in the tables. If you ever do get a funny rate for any reason, then in the exam you do it to the nearest percent. You do 10%. I'm going to do it to show you precisely what I meant, but I hope you appreciate, although I said a minute ago you get exactly the same answer, you would if you discounted at 9.52, because I'm going to do it as you would in the exam to the nearest percent. The answer I get will not be precisely the same. You would accept? But you see, all you'd need to do is this. I know it was only 3 years, but again, imagine it was 15. If it was 15, we use annuities, I told you before. He'll never expect you to set up all the columns. But all you'd need to do is say, the cost was how much? I've lost it. 120? If you ignore the inflation, the operating flow at current prices well, if we ignore inflation, its revenue of 20, its cost of 14, it's $6 a unit. And there are 10,000 units. So there are, oh dear, is that 60? Hello? Mm-hmm. If there was no inflation, it'd stay at 60 per annum for 3 years. We're nearly there, but are we all still with me? And I'm saying, as an alternative to inflating as we did and then discounting at 15, if we ignore the inflation completely and simply discount the 60 a year at 9.52%, we'd come to exactly the same. Well, I kept saying I'll do it at 10 because you would in the exam. 120 is 120. 60 a year for 3 years. Well, although you could do each year separately, since it's now an annuity if we ignore inflation, use the 3-year annuity factor. 3 years at 10% is 2.487. The present value, therefore, I get 149. The net present value is 29. Now, it won't be the same as before. I hope you're clear why, because I haven't used 9.52. We wouldn't in the exam. What did we get? We got 32 before. Well, I think you can accept it's fairly close. If you don't believe me, try this weekend doing it precisely at 9.52, and you would get exactly the same answer. All right? Now, we're virtually there, but is this making sense, please? Strictly, you do have that choice. Either do it the way we've always been doing it, get the cash flow and discount. Alternatively, you could ignore the inflation completely, write up the cash flows at current prices as though there's no inflation, and then discount at this effective 9.52. That would be exactly the same as inflate at 5, discount at 15. Okay? Now, before I finish this off, I must make it clear. In the exam, if it's 4 or 5 years, don't think about this. He will expect you to do it the standard way, and it's easy enough. I mean, for 3 years there, even if it was 4 or 5, it doesn't take you many minutes. You would agree? The only time this could be relevant in the exam for numbers is, however unlikely, if he gives you a long project, by long 10 or 15, then I've already said, if it's 10 or 15, he won't have flows keep changing each year. It'll be annuities. Well, I think you can accept, had this been 15 years, clearly that second approach would be a lot quicker. Would you agree? One reason why, if it's a short project, you wouldn't even really be able to do this. Surely this only works in this question because everything's inflating at the same rate. If I'd given you the question, like yesterday, with the sales increasing at 7% and the costs inflating at 5% or something, then you'd have to work out 2 separate effective rates, and it would start getting ridiculously messy. And usually, as I say, it is 4 or 5 years, and like yesterday, you do have things inflating at different rates. You do it the normal way. The only time this could be relevant, again, if there's a long project, and you will find if it's a long project, that everything's inflating at the same rate. In which case, you can do this. Okay? Now, have I made that clear, please? In fact, I will write down, there's absolutely no question in the exam. Only use this approach. This is the exam, obviously. Only use this approach if it's a long project. And in the exam, he doesn't play games. In the exam, a long project is either 10 or 15 years. He doesn't play silly games like here's an 8-year one, you know. It's either obviously a short one. That's usually the case. If it is a long one, fine. All right? Finally, on the numbers, I've said a million times, it's very, very unlikely he'll do this. But how did I get that 9.52%? I'm not going to repeat. I mean, I think that should have made sense. But clearly, whether it did or it didn't, in the middle of an exam, to start messing around is a bit ridiculous. There is a formula. And the formula is this, that'll give you this effective rate. I'll use the symbols he does. I'll show you the formula sheet in a minute. His symbols annoy me a bit. The formula is this. 1 plus R equals 1 plus I over 1 plus H. Where R is this effective rate that we're trying to find. Or, for reasons I'll explain in a moment, it's also called the real rate. I'll tell you why in a second. It's equal to 1 plus I. Well, I is the actual cost of capital. H is the inflation rate. And so in my question, if it was a long one, and therefore you were going to use annuities and discount at this effective, you simply say, well, the effective rate, 1 plus R. 1 plus the cost of capital, 15%.15. Divide by 1 plus the inflation rate, 5%.05. Equals, I hope I got it right before, yes, 1.0952. And therefore R, the real or effective rate, 0.0952 or 9.52%. All right? And if it did happen in the exam, write it down to 2 places. Prove you know what you're doing. But then you'd, as I kept saying, any discounting you do to the nearest percent. Okay? All right. Now, don't be angry with me, because I do keep repeating things, I know, but numbers there are very unlikely, but, well, there it is just in case. However, the more likely place it just could be relevant is this. If you look back at this example, however tiny, we've done it 2 ways, and as I say, they both give the same answer, but just look at the first one a minute. The normal way we do it. We went through and inflated the flows. We discounted the cost of capital. And when we were chatting earlier about reservations, why might you be worried about that? It's because of all your estimates of everything. And of course, a hugely difficult one to estimate, well, impossible to estimate, is the rate of inflation. We've estimated it'll inflate at 5% a year. But of course, it's impossible to predict. It might inflate at 6%, it might inflate at 10%. It can change each year. You would agree? Well, somebody tell me why, in theory, it wouldn't make any difference at all whether the rate of inflation was actually 5% or 6%, 8%. In theory, it doesn't matter what the rate of inflation is. Can anyone tell me why?
Because it influences both the price of the cost and the selling price.
Oh, no. If I gave you that same question and said, it wasn't 5%, inflation's going to be 8%. I know it influences both, but you've been multiplied by 1.08, surely these figures would be different. And if those figures are different, subject to something else, you'd end up with a different present value. Yeah? You know, all right, if inflation was 8%, the net cash flow is even higher, I suppose. But what if inflation was 2%? If inflation was 2%, your actual cash flows, do you agree, are lower? Well, I'm saying, in theory, it would make absolutely no difference. I would still accept this project. Other estimates could be wrong, but I'm saying I don't care what the rate of inflation is. I think it's 5, right, plus 32. But in theory, even if inflation turned out to be only 2%, and you do agree, if inflation's 2%, the cash flows are lower. Well, I'm saying, even if it was 2%, in theory, I would still do that project. Why?
Because we have discounted.
I know we've discounted, but hold on, you may be after the answer, but you've not given it me. If I gave you that question again, it's whatever it was at current prices, it was inflating at 2%. All right, add on 2%, those numbers would be lower. If you carried on discounting at 15%, these numbers would be lower. Do you agree? You could end up with a negative NPV. True? But I say again, we're not going to redo it, but in theory, even if the inflation was 2%, 1%, whatever the inflation was, in theory, I would still accept that project. Why? I'll tell you why. In theory, and to a certain extent in practice, clearly inflation does change from year to year. You all agree? Sorry, that's not theory, that's fact. Yeah? You know, it might be 5% next year, it might be 20% the year after, it might be 1% the year after. But in theory, as inflation goes up and down, so do interest rates. And they do in real life. It's not a direct relationship. But overall, certainly, in times of high inflation, you tend to have high interest rates. In times of low inflation, you tend to have low interest rates. I say, I'm not claiming they go together precisely, but they do tend to go up and down. Would you agree with me? And the point is this. At the moment, we are expecting 5% inflation. The cost of money at the moment is 15%. Inflate at 5, discount 15. In theory, though, if inflation turned out to be only 2%, the cash flows would be lower. In theory, though, the cost of capital would be lower as well. And that, if inflation's 2, you inflate at 2, obviously. But if the cost of capital was lower and was only 11 or something, you'd discount at 11. In theory, the two go together. The net effect of the two would be constant at 9.52%. But 9.52, we're saying that would be the cost of money if there was no inflation. The actual cost of money will be higher than 9.52, depending on the rate of inflation. You know, if there's 5% inflation, the actual cost would be 15. If there was only 2% inflation, the actual cost would be lower. But the net effect, in theory, would be fixed at 9.52. Now, am I making sense there? And I would write that down. But in theory, and it's obviously very much in theory, but in theory, the actual cost of capital again, forgive my English, but it's silly to waste time writing an essay. The actual cost of capital goes up and down with the rate of inflation. Higher inflation, higher cost of capital. Lower inflation, lower cost of capital. In theory, the effective or real cost of capital stays fixed. That again, in my question, 9.52, that's what interest rates would be if there was no inflation at all. More inflation, more actual cost, but the net result would be the same. All right? Tell me, please, because he could ask this, for our question, for the question we've just done, tell me, if inflation turned out to be 8%, what would be the actual cost of capital? Think about it. For the same question, and obviously in theory, if the inflation were 8% instead of 5%, what would happen to the cost of capital?
Rise.
Well, yes, but I want a figure. The cost of capital would be higher, but what would it be? Not precisely. Give me a precise figure. Look at that formula. She's probably right, yeah. I said 1 plus the effective rate is 1 plus the actual cost of capital over 1 plus the inflation. Surely rearranging it, if I multiply by 1 plus h, 1 plus the actual cost of capital is 1 plus the real rate times 1 plus the inflation rate. Well, I'm saying, in theory, the real rate will stay unchanged whatever happens. And what was it? Was it 9.52? Save me winding back. If the inflation rate were 5%, you've just seen, it gives us 15. But if the inflation rate were 8%, then 1 plus the actual cost would be 1.1826. The actual cost would be 18.26%, which I think is what you said. Well, it's higher inflation, higher cost of capital. The net effect, you'd end up, the inflation, the net effect would end up being irrelevant. Now, have we all got that? Just let me ask you one more and then I will leave it. What about this? Suppose for the same question, the inflation rate turned out to be 2%. What would be the actual cost of capital? Anybody got a figure? 11.17, or 7, sorry. Yeah. 1 plus the actual rate is 1 plus the real rate. 1 plus the inflation rate, which I think I did do right, 1.1171. I would be 11.71%. There would be the actual cost of capital. All right? Now that formula is given in the formula sheet and it's given that way round. If you look on your formula sheet, which I've lost, here we are, towards the end you'll see there's something called the Fischer Formula. It was Mr. Fischer who came up with this idea that they go up and down together. It's the next to the last formula. 1 plus I is 1 plus R, 1 plus H. But as always, he doesn't give you the symbols. I've written the symbols down, but just one last time. I is the actual cost of capital. R is the real or effective rate. H is the inflation rate. All right? Now, sorry spending a while there. As I've kept saying, the chances of it being relevant in numbers are small. It could be relevant for a written, just discussing the fact briefly that in theory the two go up and down together. All right? I'll tell you where he has brought it in numbers, and if he does bring it in numbers, probably the only place. It'll be a 4 or 5 year project. You'll have flows inflating at different rates, like my example yesterday. But instead of telling you the actual cost of capital, he'll say something like, the real cost of capital, 12%, the general rate of inflation, 4%. Well, he'll expect you to discount, like yesterday, the actual cash flows at the actual cost of capital. And so what is the actual cost of capital? The actual cost of capital, well, I'll write the whole thing down. You will discount the actual cash flows at the actual cost of capital and finally, last bit of numbers, what would the actual cost of capital be? Well, using the formula, 1 plus I, it would be 1 plus the real rate times 1 plus the inflation rate. $1.1648. You'd therefore discount at 16.48%. But of course, you'd use the nearest figure for the tables. You'd discount at 16. Discount actual cash flows at actual cost of capital. Doesn't do this often, but you need to check carefully. If he's given you the actual cost of capital, you use it. If I say the actual cost of capital is 20%, you discount at 20. You agree, Vita? On the odd occasion, though, instead of giving you the actual cost of capital, he's told you the real cost is 12, general inflation is 4. You've had to work out the actual cost of capital using the formula, and then you're back to what we had yesterday. Okay? All right, nobody looks terribly happy about that, but still. I say it's not that common. It's actually very easy. The only real relevance in the exam could be that for numbers. Discount actual flows at actual cost, but just check he's given you actual cost and not real cost. Okay?